John, you've got this framework, the new nominal. I'll allow you to explain that in just a moment. The conversation we're having, once we start raising interest rates in America, maybe the back end of next year, who knows, Sean? I can't predict next year. How steep will that policy path be? How shallow will it be? How loose will any potential tightening be? The answer to that, John?
I think it's going to be the shallowest we've seen in decades. We have to go back to maybe the 50s or 60s to see the same kind of shallow patterns I think we're going to see. So nothing of the recent cycle I think is a guide, much shallower. And I think we've seen much more ongoing evidence that they are on the slow path. I think they've been very deliberate to try to separate the taper discussion last week from the liftoff and from what it's worth. We cannot predict 2022, but I think it's a 2023 story, the first rate hike.
John Boivin, BlackRock and your team unabashedly say you're pro-risk. I mean, you mince no words about it. How do these changes, the worry out there, affect corporate thinking with a higher yield regime, with a steepening of the curve, and on and on? How does pro-risk come over to corporate action?
Yeah, so the path ahead for equities or risk assets to break higher is getting narrower. So I mean, I just want to acknowledge that. And after a streak, I mean, you look at the chart of the S&P. You start in January 2020, and you look at it, and there's no way you can tell there's been a pandemic. So I mean, this does raise question. I think we're going to be in an environment where markets will be more primed to look at risk and maybe more volatility. But in that environment, we still think that the fundamentals are constructive for the time being, and as a result, we would look through that. That's where the pro risk on the bashing version is coming from.
How concerned are you about what's going on in China with respect to not only the scrutiny of the tech companies, but also what some people are calling an increasing energy crisis, especially as the regulators try to clamp down on fossil fuel usage ahead of the Olympics?
Yeah, so I think, broader story in China is that, the direction of travel towards a greater role of social objective politics over economics is unmistakable. It's playing out, and I think we should all acknowledge that. It changes the lens of investment. However, we've seen a very steep decline in activity throughout the course of 2021. I mean, from 18% earlier this year to Q4 that's going to look sub 4 as far as we're concerned. So that's a pretty steep decline. And even a country that is, on a path to put other objectives in front, I think they cannot ignore this weakening growth. So that makes us, we've been neutral on Chinese equities for the last few months. But we start to think now that it's time to dip our toe back or start to dip our toe in the Chinese equities, given that, we see some easing of the various policy tools over the next few months.
Wait, Jean, can you elaborate on dipping your toe back into Chinese equities? Where do you see as sort of a safe place to park amid still a lot of ongoing uncertainty?
I should clarify the back, because we've just broken out Chinese equities as a standalone asset class for the first time in June, our mid-year outlook. So, I mean, there's no back aspect. So, but we're dipping our toes in the sense that, you've seen a 25% underperformance of the Chinese equities over U.S. equities for good reasons. That's why we were neutral. But at the same time, that's a pretty, the gap has been pretty material in terms of the two regions. And while there's a lot of uncertainty, I mean, that means the risk premium has increased quite considerably. And now I think it's the time to think about opportunities reappearing. I'm thinking about broad market exposure here as opposed to specific. And but that broad market exposure, that broad market story, I think has repriced quite a bit.
John, just quickly, final question. How do you reconcile your bond market call, your Federal Reserve call, with where you want to own in the equity market domestically here in America?
So we think the bond market call, just to clarify, is we think rates on the way up on the 10-year. We've been increasing our underweight of U.S. Treasuries over the course of the last few months. Our conviction has not waned, despite the fact that it had been stubbornly low over the course of the last few months. But we think the direction is up. That said, it's in the context to go back where we started, where we're going to see a very shallow normalization of policy rate in the U.S. And as a result, and some more inflation coming, But this combination of inflation coming through with very low rate, it's a real rate environment that's very negative and continues to be, and that will be supportive of equity or risk asset, even in the U.S. We're neutral on U.S. equity, though, just to be clear, and I think that's more coming from at this juncture, the fiscal policy landscape on the tax front, debt ceiling, and we're gonna hear more this week.
Wait, hold on a second, Jean, just right there. I want to make that clear. You care about the debt ceiling.
We think there's headline risk around the debt ceiling. Ultimately, we put out a note last week where we say, there's going to be noise. The market is prone to be reacting to noise in this juncture, like we said, but we will advise looking through. But the headline risk is there. But again, we have uncertainty around how big these package will be as a result. We have uncertainty around corporate taxes and the like, and that's the neutral stance on U.S. equity.